Hey, if you're a multi-unit apartment developer and you are looking to create a financial model for a new development in order to raise the debt and equity capital you need to get the project off the ground, then you've come to the right place. We have created a financial projection template, a model here built specifically for multi-unit apartment developers. And I'm going to walk through how this template works, how you can fill it out. First, just a little bit of background. My name is Adam Huxema. I'm the co-founder of Projection Hub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for all sorts of different industries and businesses. Specifically today, I'm focused on our apartment developer model here. And what I'm going to do is walk through real quick kind of the high level what's in the model. So you don't have to watch the whole thing to kind of see what you would get. And then I'm going to go back and really dive in deep into each of the sections of the model as well. So if you stick around to the end of the video, we're going to, as a thank you for making it through, we're going to give you a discount code, access to a discount code to grab this template. And we'll also put a link to the template down in the description of the video below so you can grab that as well. All right, with that, let's go ahead and dive in and I'll show you how this works. Okay, so we are going to start here on the At a Glance tab. And this is kind of what you're going to get at the end of the process. So after you have completed filling out the entire model, then you'll be able to see a cash flow at a glance for 10 years. You'll see some key ratios, some summary data on the model, construction budget breakdown, use of startup funds, and some different graphs and charts that you'll be able to use to present to a lender or investor. You will also get a 10-year cash flow summary by year. You'll get a balance sheet summary by year here for 10 years, and then an income statement summary by year, as well as a cash flow statement, income statement, and balance sheet, all broken down by month. So if you need that monthly detail, you do have all the monthly financial statements as well for the entire 10-year model. You will also, let's look at some of our input tabs now. So you will have a input revenue tab where you kind of build out your unit mix of the types of apartments you plan to have, what you're going to charge, when you think those will be, construction will be completed and those will be rented out. You will be able to input your operating expenses as well on a per property, per unit, or per square foot basis. You can also enter in expenses as a percentage of revenue, as well as a reserve for replacement section here as well. And then a input salaries tab as well if you want to enter in salary positions for operating the complex after it is built. Now, the revenue and the expenses will help you forecast your net operating income. And once you have an expected net operating income, so for example, what we've filled in here as a default, we have a monthly net operating income once stabilized of $105,000. Now with that in mind, and a 1.2 debt service coverage ratio that we're hoping to get, or our lender wants us to get, we can then predict or forecast what's our maximum monthly loan payment that we can afford. And so based on that net operating income and that debt service coverage ratio, the model's saying, hey, we can afford $88,000 in monthly loan payments. And then it's asking us, okay, what's your expected interest rate and the term on that loan in order to calculate a maximum loan amount. With a targeted debt to equity ratio, it'll also estimate how much equity we'll need to raise and ultimately give us kind of our total budget for construction or for the project in total. And there's a lot more here on entering in our specific financing sources that I'll get into in detail a little bit later, but including refinancing with mini perm and perm debt as well. But let's just take a look at the construction budget here. And so you'll be able to enter in specific construction budget items per unit basis or per property. You can categorize those expenses as building and improvements or land, furniture and fixtures, and so on. And you can also build in kind of future fixed assets. So if you think, hey, in every 5 years we're going to do a refresh and we are going to do some renovations and we want to budget for that in the model. So you can build that kind of thing in here as well. And then ultimately here, once you've got all of that done, we have this kind of distributions, investor kind of distribution model here. And so what this will do at a high level is show you your cash flow projections. And you can set a percentage here that you want to keep as a cash reserve. So you're saying, hey, in the early years, cash is tight, and so we're going to keep 100% of our cash as a reserve. After year 7, we're going to start distributing 50% of our cash to investors. And then ultimately down here, you can set some sale assumptions. So we're saying, hey, in year 10, we're going to sell the property at a 5 cap. And based on all of those assumptions, the net sale proceeds would be $19 million. And the model then will show you, okay, based on those sale assumptions and distributions over time, we can see that the IRR after the sale for the investor would be 17.5%, right? So you kind of come full circle here and being able to model out potential investor returns. So that's kind of at the high level. I do want to dive in a bit more onto how to actually fill out the input tabs here. And so I'm going to go back now and do that for you. But I'll take a pause here just for a second and say, if you have questions about the model already and you want to reach out, the best way to contact us either in the comments of the video below or support@projectionhub.com, and we'll reach out to you and try to answer any questions that you have. All right, so let's just look at how we would fill this out and how it's kind of already filled out as a default. So we've got an apartment project here that we are saying we're going to start. And the projection start month will be January 1st, 2024. We are going to build a 100-unit apartment complex. So we've got 10 studio apartments, 31 bedroom and 62 bedroom units with 500, 750, and 1,000 square feet per unit, respectively. And then we calculate our annual rent per square foot here at $22, $21, and $20, which then here you can see kind of your what the tenant would actually be paying for a studio apartment. A tenant would pay $917 a month, $1,313, and $1,667 per month. And then we can estimate when these different units will be completed from a construction schedule perspective. So we have some distribution here. Maybe the studio apartments are on the first floor and it's going to be done first or something like that. So maybe that's done in month 17 and the other units take a little bit more time, right? So then you can say, okay, this is when the units will be done, and we can start renting, 1 month later. And then this field tells us how many months do we expect it to take for us to rent out all of these studio apartments. So we're saying it's going to take 6 months to rent all the units. Here you can add in additional revenue that you expect to generate per month for these different unit types. So say parking, maybe you offer parking for $50 a month. Maybe you offer storage for $50 a month. Now, not all of your tenants will necessarily want to pay for parking or storage. And so I'll show you how to adjust for that here in a second. But here's where we can add a annual rent increase. So I've got set here a 5% annual rent increase. And we've also got our vacancy and credit loss percentage here. So what we're assuming here is that in the first year, we're going to have a 15% vacancy rate, moving down towards a 5% once the property is completely stabilized. So this 5% would be a mix, or it'd be both the credit losses, so people not paying rent and you just don't get paid, so maybe that represents a couple percent, and then your vacancy rate represents the difference. And so the 5% is the total vacancy plus credit loss. So 5% is operating really well if you're able to achieve that. Now, here's where we can set what percentage of our tenants are going to pay for parking. So we're saying, hey, 20% of tenants are going to pay for parking, and 10% of tenants are going to pay that additional $50 a month for storage. And all of this is ultimately going to allow us to forecast potential gross income or gross potential income, and then our vacancy and credit loss, and our EGR, our effective gross income. Now, all of this is blank right now because this is the construction period, so we actually need to scroll over if we want to see where this actually starts to come into play. So now we can kind of see this looks like, once rent and parking fees and storage fees start populating, and the vacancy and credit loss numbers as well. Okay, so let's go ahead and jump over to our input operating expenses now. I know I've already gone over this a bit, but just to provide a bit more detail, so you can add expenses like our grand opening marketing. So let's say we want to start marketing for the grand opening in month 15. This is only going to last for a few months, right? So this is going to last until month 20. We're going to pay $5,000 for grand opening marketing during these months. And then we can have an option here to say, does this repeat each year or not? We're going to say no, because you're not going to grand open again. But you could have other expenses like real estate taxes that, let's say they hit for the first time in month 19 of the model. And this is going to repeat each year. And so you put the first payment month is 19 and the last payment month is 19, meaning this expense is all paid in month 19 in the model and then every year thereafter. And the model will apply this growth rate, so 2%, 3% annual growth rate for those expenses. So that's an example of how you could use kind of repeating annual expenses. And then you also have the ability to add expenses on a per square foot basis. So if you wanted to budget maintenance costs on a per square foot basis, we could say, okay, we're going to pay 10 cents per square foot in interior maintenance per year. You may also have per unit costs. So maybe you have unit turn costs for turning the units after tenants leave, and we're going to expect, hey, it's going to be on average $50 per unit per month for those unit turn costs. And then finally, you can have entire property costs. So an example there could be software to manage the property, and we're going to pay that $2,500 a month for our property management software. And right now we have this starting in month 1, but we probably don't need that yet. We don't need that until we're open. So maybe we'll adjust that to, say, month 18. All right. If we scroll down here, we also will see our percent of revenue expenses. So let's say you hire a property management firm and they're charging you 8% of revenue to manage the property. So we can see that 8% here. And maybe whether that same property management company or just your internal staff are kind of doing the general and admin costs, so your accounting and that sort of thing, can be represented here with a 2% of revenue. And then again, you can set aside a reserve for replacements annual budget here. And if, for example, you decided you did not want to hire the property management firm that's going to charge you a percentage of revenue, you could put 0 in for those percentages, and then instead you could hire salary positions, a facilities manager and maintenance staff to manage the property. Now, I have set this right here. It says number of this particular employee. I've set this to 0 because I didn't want to double count. We're hiring the property management firm in this example, and so we don't want to also hire a facilities manager. But just to show you that that is possible, you just want to make sure you don't double count that. All right, so let's dig into a little bit more detail on the input financing here. I've really walked through most of this already, but you'll notice some of these different cells that are highlighted in green, and they could turn to red if the numbers that you have in here aren't working, right? And this is really a puzzle to try to get this all to work. And so, just as an example, let's see if we can make this turn red. So let's say our desired debt service coverage ratio was 1.3. Now we see, our numbers are not going to work at that ratio. So the numbers we have in here work at a 1.2, but not at a 1.3. And so you'll see as you make changes, you're kind of working to try to make sure that everything is green or avoiding those red issues. So you'll be able to enter in your specific equity sources here. So let's say, maybe you already purchased the land for $250,000 or a portion of the land, and that's going to be your equity in the deal as a developer, but then you also have outside equity coming in from other investors at $4.75 million to come up with a total equity of $5 million. You'll be able to enter in loan financing costs for each of the kind of 3 potential loans that you might have. So you have construction debt, maybe you refinance to mini perm debt, and then to permanent debt later. And so along the way, each time you'll probably have some loan financing and closing costs and inspections, bank charges, appraisals, all those sorts of things, legal. And so what I have right here, this is assuming, if you look up at the equation, it's assuming a 1.5% of the loan value as a financing or closing cost. And it's the same way here for the mini perm, 1.5%, 1.5% for the permanent debt. So this table will help you say, okay, here's our construction budget. Here's our total financing costs. Hey, we're going to need some working capital to operate the thing as it gets up to stabilization and is full with occupants. And then we also take out the equity there to kind of figure out, hey, what's the minimum construction debt that we need to cover our costs, and then there's also the maximum debt for desired debt service coverage, right? So it's saying, well, if we want to have that debt service coverage ratio of 1.2, the most we can take out is 15.1 million. So that's why here I've got a $15.1 million loan, construction loan. Now the problem and the reason this is still yellow is because this part of the model is saying, hey, look, you actually need 16.4 million to cover all of your construction costs. But since we have some extra wiggle room in the model and some extra equity in the model, we're still going to be okay. We can kind of move forward even though we're yellow here. 7.75% interest rate that we're assuming for the construction debt phase, and then that will refinance. We're saying that's going to refinance in the model in month 30 into mini perm at a lower rate, and then permanent debt in month 60 at an even lower rate is what we're expecting and modeling here. Okay, so the last thing I really want to, I think, hit on the construction budget is just to note your cost per unit and make sure that, hey, this is the $170,000 cost per apartment unit. Is that reasonable? Is your construction, just because this works on the financing side, it also has to work in the real world. Can you actually build this 100-unit complex for this cost, right? That's the question. And so, if you get back and say, boy, we really can't, your options are then to, you got to go back and play around with all these numbers, right? To say, okay, what can we do? Can we raise more equity? Can we raise more debt? Do we think we can get a lower interest rate? Can we get the bank to agree to a lower debt service coverage ratio? All these things are potential levers. Do we think we can increase our rents? That's a possibility too, and that would help the model be able to support a larger construction budget. And then finally, just again pointing out this distribution model. And so, this is a very simple distribution model. We know that a lot of projects are going to have waterfalls and very much more complex investor setups where you really need to model out a waterfall. And that is just something that is hard to build in a default model. And it's really something that's just going to need to be customized on a case-by-case basis. So again, if you have questions or need help doing that, we're happy to try to help with that. So reach out to us at support@projectionhub.com. Okay, I think that is everything that I wanted to share. Thank you for sticking to the end. And so, like I had mentioned, if you go in the description of the video below, there'll be a link to a form. If you fill out that form, we'll email you a coupon code that you can use to purchase this template as our thank you for watching to the end. And again, have any questions, reach out. We'll be happy to help. Thanks.